Hi, my friend, Caleb Johnson here, and I have a huge question to ask you, real estate investors. How would you rate your level of personal discipline on a scale of 1 to 10? If your answer is anything less than a 10, I've got something neat for you. And let me tell you, discipline means pushing yourself beyond your comfort zone and doing things that are difficult and sometimes boring. Achieving massive success requires you to do those difficult things. Building your levels of personal discipline is not easy, but it does pay off. In fact, you can't achieve anything significant without discipline. Now, I just released a program for investors where I walk with you as an accountability coach to aid you stay on track so you can push yourself to do the hard things that greatness is going to require of you. Starting is easy. Go to redccapitalgroup.com and click accountability coaching at the top right of the screen. So let's get to work, and now to the interview. Hello everyone, my name is Caleb Johnson, host of From Trial to Triumph. This is the show where I speak with people who have gone through tremendous trials and have come out triumphant. And even if you don't have the same story as our guest does today, that's okay, because you can still learn from their learning lessons and apply them to your life. And I'll do my best to bring those lessons into full view. So with that, our guest today is David Lindahl. David has been investing in real estate for over 26 years, living through 3 market cycles. He has been teaching others how to invest for over 21 years. Additionally, he has written several books and has worked with other giants of industry, such as Tony Robbins, Robert Kiyosaki, and Donald Trump. So David, welcome to the show.
All right. Thanks, Caleb. Glad to be here.
Thanks for being here. I'm really excited to have this conversation with you. And, for the 2 people that don't know who you are, can you go ahead and give a little background story about yourself and really how you were able to get to where you are today?
I started out way back when I was a teenager in a rock band called Flesh Picnic. I was lead vocals, and it was awesome.
Wow.
I grew up in a very lower middle class family. My father worked sometimes 2, sometimes 3 jobs to support us. My mom was a fish cutter on the Fish Piers of Boston, and I was a very degenerative kid. And I joined a band when I was 16. I left the band with a few brain cells when I was about 24, 25. And that's when we almost made it. Then we didn't. And then I realized it's like, man, I'm tired of being broke. I just want to make some money. So I started a landscaping company. I borrowed my father's lawnmower. And it's funny because I'm telling that story, and today when I was talking to a broker, because we're all getting reset for this next, this big run that's happening. So now I'm reaching out to new brokers and all that. And one thing about broker relationships is you always find that commonality. So this broker started a landscaping company mowing lawns when he was 15. He happened to mention, and I was like, boom, there's my commonality. So I was telling the same story today about how I started. I borrowed a lawnmower from my father. I went door to door to anybody who had high grass, asked them if I could mow it. Got a bunch of accounts first couple of years, but then in Boston, things freeze over. So you can't do anything in the winter. So I did odd jobs to survive the winter. Had a friend ask me he was working for a bank. And he said, I know you're struggling. Why don't you do the rehab for this property that the bank foreclosed on right before, a couple of cycle of foreclosure booms. So I said, sure. Had no idea how to do the bid. Asked my cousin to bid it for me. Won. They made sure I won. And then I didn't know how to do the work. So I had friends, family members, my cousin helped me with the work. Got it done. The bank liked it. Asked me to do another one. I realized I could, I was like, people are making money doing this, and not only are they making money doing this, but also flipping houses, because either homeowners or flippers were coming in to buy this property. So I started asking the flippers, what do you do? What are you looking for? How do you do this? And somebody said, get Carlton Sheets course, learn yourself. So I did. Get Carlton Sheets course, and I didn't do anything with the first one. I was so busy with my landscaping and all that stuff that when he had the new improved edition, I went out and got that one, and then I actually opened it. And the biggest piece of advice I got from that course was go to your local real estate investment association. Realize that there are people in there that look just like you, they dress like you, they talk like you, and some of them are just starting out like you, and some of them started out a couple of years ago and they're doing really well, like you will do. So know that you can do it too. And that's what happened. I went in there with the mindset of, there's people in there like me and they're doing it, then I can do it too. So that was all single family stuff. I saw an interview. The thing that really changed me was I saw an interview with Harry Helmsley on biography. And he started buying and selling multifamily properties in New York City and ended up owning the Empire State Building. And he started out broke. And the interviewer said, Harry, what was it about multifamily properties that got you going? Harry said, I always liked the idea that a group of people would pool their money together and give it to me so I can pay down the mortgage on my property. They'll give me money every month and give it to me so I can pay for a maintenance guy to swing hammers and take out trash so I don't have to. They'll give me money every month and give it to me so I can give it to a property management company to take the phone calls of the tenants and collect the rents. And after I pay those bills, they give me so much money that I had extra money that I could reinvest, put into a savings account, or just go out and have a bunch of fun with. I thought, damn, if that's true, I want in. And if you can do it with no money, because I was still broke at the time, then I really want in. And I went to my real estate investment club and I told everybody what I was going to do. They're like, you're crazy. Multifamily properties, they're going to trash the place. They're not going to pay you. You're going to have to evict them. And I was like, damn. But, it just seemed right to me, So there was like 2 or 3 people in that group that were investing in multifamily properties. They were driving better cars, wearing better clothes, taking longer vacations. So I started taking them out to lunch. And I was saying, what is it? First it was, is it true? And they told me, oh, it's absolutely true. And secondly, I would say, well, why are you going to that group? And they said, because they're all flippers and they get multifamilies that come in, they don't know what to do with them, so they give them to us. So that was like a deal source place for them. Mm-hmm. So even though they told me it was true, it took me they taught me a lot, and there was nobody out there teaching back then how to do multifamilies. So I was out bird dogging for them. So that's how I learned what a good deal was. And there was so much fear involved in my first deal that I bird dogged way more deals than I should have. And finally, after 9 months, I got over the fear and I did my first deal with my partner, who was my best friend, who was just as broke as I was. And I remember him telling me, everybody that I told that I was going to invest in multifamily, they said, Dave, you do that, you're going down. It was like the common theme, you're going down, And so I told my best friend, I said, people tell me that if we do this, we're going to go down, because I want him to go in with his eyes open. And he said, I'll never forget what he said. He looked down at the ground, and he looks back up at me, and he says, Dave, how much lower can we go? I was like, right, Right. Neither one of us, we were working, I was working my landscaping company. He was working the second shift at this company called Chadwick's, a clothing store. And we were both doing a third shift over on Thursdays and Friday nights at St. Johnsbury Trucking, the third shift, because they paid you double time to make ends meet. So I was like, what do we have to lose? So 9 months, we got our first property. So excited, couldn't believe it. Within 3 months, we had 3 more. Within 6 months, we had 9. That first year, we had 11. Within 3 years, we had 40, close to 40.
Wow.
So it really took off. Cookie cutter, but we were in the right market at the right time. I didn't know it at the time. But as I'm going through this, my life changed dramatically. I had all this cash flow coming in. It just kept getting bigger and bigger and bigger. The equity in my properties kept increasing. So we were multimillionaires on paper by year 3. But I kept learning, and I learned about market cycles, and I learned that what goes up must go down. And I learned that I needed to either take the cash off the table, while the cycle went down and wait, or go into another market that was emerging, like Brockton, Massachusetts was when I first started. And so I decided this is too fun of a game to play. I didn't want to go on the sidelines for a couple of years. So I learned how to go around the country and find emerging markets. My first market was Montgomery, Alabama. It's all about job growth, following job growth, following household formations. So I went out. We went down to Montgomery. They were building the Kia plant down there, bringing in 5,000 new jobs. Anytime there's a lot of jobs coming in, like 500 jobs or more, there's what's called the multiplier effect. So for every one job, there's 3 to 15 more jobs coming in. So Montgomery had a small multiplier effect. It was a multiplier of 3. So, but yet there was still 15,000 plus 5,000, 20,000 new jobs coming into this marketplace. So in Montgomery, we're surrounded by a floodplain. So that's a barrier to entry. So now, we've got a market that has a barrier to entry, 20,000 new jobs coming in. The supply is going to remain the same, but demand is going to start going up. And that's when values start going up. So that's what happened. First market, Montgomery, did a couple of deals there. And then I started learning how to do it. I made some mistakes. I went up to Huntsville, about a 400-unit property, thinking I was the balls, you know what I mean? Like, I can do this, no problem. And man, that was a repositioning. It was 46% occupied. It was like a little village.
Wow.
And I made so many mistakes in that deal, and I learned so much. But then we worked our way over to Montgomery, Alabama, Jackson, Mississippi over to Texarkana, Texas. And from Texarkana, we kind of went into Texas. We were in 11 different markets, and we worked our way up to 9,000 units in a total of probably 18, 19 different markets at the same time. We
Wow.
kind of like, just like I did the small multifamilies, I discovered a cookie cutter method. I did the same thing with emerging markets. I discovered how to get in, how to build a team, how to get the right deals, and then how to operate those deals while I went off and did the same thing somewhere else. So yeah, so at one time we were in 18 different markets. I think total I've been in about 28 different markets throughout, since I started investing in 1996.
Mhm.
And we're getting ready for this next run. It's going to
Wow.
be, it's coming. It's exciting.
David, I'd like to talk a little bit about that. And thank you so much for sharing your story. It's incredible listening to that. And I think incredibly motivating as well for people listening. And shifting into, you've preluded a couple times that there's going to be another cycle. And so, what indicators tell you that?
It's not that there's going to be another cycle. We're entering the up cycle of the cycle because the market cycles are continuous. There's four phases of a market cycle. The best part about the market cycle is they're predictable, the different phases of them, as long as you know the transition points. And see, each particular phase has key characteristics, and each particular phase has a key strategy: buy and hold, or flip. So so in this turn, what we're seeing is, this market should have turned after the last election, but because of COVID, it extended it. So when COVID came on, what happened? There's a lot of multifamily properties that got in trouble. The C minus properties mainly.
Mm-hmm.
A's and B's did well if you're a good manager. You did well if you had good management working for you. It was typically the mom and pops that had difficult times. So I thought that was going to be a huge opportunity to invest in multifamily because I thought a lot more were going to come onto the market. That didn't happen because office and retail got so decimated by COVID that those investors went to the safe spot, which was multifamily. So that actually extended the rally for 2 years longer than it should have. And it compressed the cap rate so low that in 2021, we were getting unsolicited offers on our properties. And it was like, I was talking to my partner. I was like, hey, somebody's going to offer this much for a deal that we had in Huntsville, this much. They're like, really? It's like, yeah. It's like, wow. So then like 3 weeks later, hey, another broker just came with another unsolicited offer, and it's more than the last one. And so then we get the property we got this property under contract, right? They said they were going to close in 30 days all cash. So like, okay, it was like a $5.1 million deal, I think it was. The property was probably, we thought it was worth about 4.6. So at 5.1, we were all in. And then they didn't close in 30 days. They dicked around with us for a while. It didn't really, we knew we were going to close eventually, but they kept being out of contract, which was a problem for them a little bit later because all of a sudden we got another unsolicited offer for 6.4. We're like, holy crap, 6.4, we have it under contract for 5.1. But it wasn't under contract because they wouldn't, it was a 30-day close and they never got an extension. So we went back to them and said, hey, you guys aren't under contract. We're going on market now for highest and best. And they're like, no, you can't do that. And we said, yeah, you didn't protect yourselves under contract, number one. Number two, you dicked around with us for this is like on the 90-day mark. So it wasn't like the easiest buyers. And so we go on the market, we get a 6.6, 6.4, and a 6.2 offer. And they walked, but we took the 6.4. Sometimes the highest offer isn't the best. You know what I mean?
Mm-hmm.
The most qualified.
Mm-hmm.
And then we started seeing that in the different markets that we were in. So we went from a pretty large portfolio. I'd sold off a good portion prior to because I thought we were near the top of the cycle. I had most of my legacy properties left, but then these ridiculous offers in 2021, we're down to probably 3 properties now.
Wow.
So it was good. So the people that bought in 2021 and 2022, that was like 2007, 2008, 2000, 2001. It was just, the top of the market. Those are the deals that are going to be coming onto the market over the next year, 2 years.
Mm.
And
Okay.
that's so exciting. It's so exciting because for the first time since I remember, bridge financing was lower than conventional. So bridge financing is the financing that you use when you can't qualify for conventional. But you only need it for like a short period of time. You need to fix something. You need to fix occupancy. You need to fix expenses, maybe increase the rents. But something's not working out, so you can't get a Freddie Mac Fannie Mae loan. So for the first time ever, it was lower. So now a lot of people started penciling their deals using bridge financing. The problem with that is it's short term. It's due in 2 years, 3 years, 3 years usually at the max. So now with interest rates going up, everybody that took out those bridge financing, they can't refinance. They're going to have to give the properties back to the bank because they're going to try to wait this out. There's already a lot of capital calls going on right now in the marketplace. But those are the deals that are going to come back to the market. We've already seen some of them coming back to the market. And when they coupled the bridge financing with the value add that they were expecting to raise the rents, and there's a lot of syndicators that were giving preferred returns that accumulated. So let's say there's a threshold of 7%. And if they didn't hit the 7% going in, it would accumulate over time, assuming that they would hit their value add, and on the resale, they would pay everybody off and they make a bunch of money. Well, the value adds aren't happening, because the rents, I think it's the last survey was 72% of the markets are either stagnant or in decline. So those properties are going to come back on the market. So that's what we're seeing. And with the interest rates going up, so we're in like a transition year right now. It's like 2009 all over again. So the sellers aren't quite ready because all their friends got these high prices, and they get these high offers, but they thought they'd hold out and get even more. They got greedy, and so their mindset has to change to realize that if they really want to sell their property, or they need to sell their property, they need to take a lower amount. And where the debt cycle is right now, the capitalization rates haven't risen above the debt rates, which they need to do to make the market normal again. So as that is happening, that's the big reset in the market. So you get in at higher rates, and then you get in conservatively, like everybody should have been investing anyways. And then, you buy these deals that are popping up. I'll tell you, 2023 is going to be like popcorn. Deals are going to pop. And that's like the Jiffy Pop. You ever do that Jiffy Pop over the stove, Right, 2024, 25 is going to, when it's like, comes up.
I love that popcorn.
Yeah.
Wow.
So that's what's happening. So we're getting ready. We're by the campfire, getting ready. We're making the s'mores right now. We're waiting for the popcorn to hit.
That's a good place to be. Now, David, what are you doing to prepare for that, let's say 2024, 2025?
So we figure we raised like a lot of money during the last run. And yet at the same time, we've been doing one-off deals for the last probably 5 years. I really thought this market was topping out 2017, 2018, like it should have, 2019, but it extended. So we were like really, really conservative. We weren't going in. I remember there was this big rehab in Oklahoma, 300 something units, where the back end looked huge. It looked like it was a great deal, but you just don't know when that market turns. In 2008, when Lehman collapsed, nobody expected that to happen, and that collapsed the market overnight. This market didn't collapse as fast, but you could see it coming. So I get very conservative, being my third cycle, and I just wanted to do one-off deals that made a lot of sense. So I wasn't doing as much. I had people saying, people thought I was crazy for not doing these deals, not doing these deal structures that people were doing. And so now I was like, no, I'm ready. My partner was even saying, hey, we got to do more deals. I was like, no, we don't. Just let's take a break. We're going to run hard when this finally does reset. So that's what happened. To answer your question, we weren't using a lot of it. We had a lot of investors, so they found other alternatives. Some of them we retired because of the amount of money, that we made. So they're not investors anymore. So we're restacking our investor pool, getting ready for the next run. And then we're making new relationships with brokers in the key markets that we want to be in. So that, like I said, that's what I was doing today. It was a brand new broker. Guy was 25 years old, been in the business for 2 years, since 2020. But his partner's been in for 40 years. And they've got a good model going on. So
that's good.
So it was good for you today.
That's good. And you mentioned earlier the 4 phases of a cycle, and I've actually never heard that before. So can you share what those 4 phases are?
I'm going to have to send you my book, Emerging Real Estate. I will. Send your address. So the 4 phases of the market cycle, it's like a roller coaster. So on the emerging side, it's a buyer's market phase 2, right at the bottom of the trough. And that's when that transition point is when rents start to rise for the first time after a number of years on the decline. So then you go up about, I don't know, a third of the way, maybe near closer to the half, and you go into a seller's market phase one. That transition point is when the rents have risen high enough to support new construction, because there's no new construction going on between those two phases, between that and there. Then going up into about 3/4, maybe 4/5 of the way up, you go into a seller's market phase two. The key characteristic there is that job growth has slowed down, all right, and that's the market slowdown. And then the market rolls over. You go about a quarter of the way down, you're in a buyer's market phase one, and that's the decline of the market. But let me just share this analogy, or it's not an analogy, it's simple truth. At the very bottom of the cycle, the very bottom of the trough of this roller coaster, we're at the end of a buyer's market phase two. Now, the way we know that we're there is because they start announcing jobs coming into the marketplace. We're looking for announcements of jobs in one company, 500 jobs or more. Then we'll call over to the Economic Development Committee and we'll say, hey, what are you doing to attract jobs? They're usually giving free land, free money, tax abatements, or grants. So in doing that, if they're doing one or a combination, hopefully a combination, we try to find out how aggressive they are to determine if we want to be in this market. But the one thing we know is that once the jobs start coming into the marketplace, that market, still has some downward movement in it, but maybe 5 or 10% at the max. Because eventually they're going to pull the permits for these new jobs, these new buildings that are coming in. The workers are going to come in behind that. They're going to start renting apartments because most of these construction workers are transient. They go where it's good. They're going to start absorbing the oversupply, and then the rents start to rise. When the rents start to rise, that's when national investors get interested. They're like, okay, on the left side, on the downward slope, you're a contrarian investor. Once those rents start to rise, now you're a momentum investor. So the national guys that are momentum investors now that's their big green light. Rents have started to rise. I'm in. So they come in, you get to the next transition point with the seller's market phase one, and now the rents support new construction. Now the builders are in. Okay, so they're building. So now you got to be careful, because if you're buying a B property and it's next to a brand new A, you're in trouble for a couple of years. And then as it continues to ascend forward, the affordability index gets to be about 0.72. The affordability index says that how much does the average wage earner, how much can they afford in a single family house? When it's 1, it's equal. When it goes down below 1, it means they can't afford as much of a house anymore, or a house. So at 0.72, that's when the condo converters come into the market, because people want the American dream. They can't afford a single family detached house. They buy a condo. So now you get the condo converters in. So the analogy is, or the truth is, the earlier you get into a market, the less your competition. So when you're in on the contrarian side, it's just the local guys, and you're usually buying from the people that bought wrong in the last cycle. So you can negotiate really good deals. Once you get over to a buyer's market phase two, now you're into the now you're competing against the national guys. Once you get into the seller's market phase one, now it's the locals, the nationals, and the builders. And then as you go up, now you get the condo converters. So the longer it takes you to get into an upside on the cycle, the more people you're competing against. Not that you can't make money, but there's a whole lot of easy money to be made when the earlier you get into these cycles.
Wow. I hope the listeners, I want the listeners to go ahead and rewind that back 3-4 minutes and just rewind that and listen to it again and again and again. That was gold, David. That was amazing. And I'm sure your book is just full of those nuggets. So I'm going to have to read and reread your book again, especially with where we are in the cycle.
It's interesting. I wrote that book. That was in 2006, and the only reason I wrote it is because I'm in Texarkana. I was by myself. I had 3 properties there. I was eating at the bar, and the guy next to me says, I can tell you from Boston. I used to have a really thick Boston accent back then. He says, I can tell you from Boston. What are you doing down here in Texarkana? And I said, I own a couple properties here, a couple apartment complexes. He says, what are you doing buying down here? So I explained emerging markets to him, why I'm in particular markets. He said, that's fascinating. He said, I'm a writer for Kiplinger's magazine. Can I do an article on you right now? And I said, my father reads Kiplinger's magazine. That's what I'm thinking, right? And I was, I was derelict in the rock and roll band. I was like, this is going to make my father so proud. He said, absolutely. So he did the article. It came out the next month. I handed it to my father, opened up the page with me on it. It was awesome. That was an awesome moment in my life. And then about 2 months later, I get a call from Wiley. And Richard Narramore says, hey, I read the article in Kiplinger's. That would make a good book. Would you be interested in writing a book about that? And I thought that would make my mother proud, and all of them in the family. So that's how emerging real estate markets got written. And then that was number one for a long time. And then they called me back and said, you want to write a sequel or something else? Because, that one did really well. I thought, I'll write Multifamily Millions. So I wrote Multifamily Millions. That was out and number one for a long time. Still a starting point for a lot of people. Now there's a lot of multifamily books out there, but that was a starting point for a lot of people. And then Trump called me and said, hey, you got two number ones. You want a third? I'm like, yeah. So I wrote his Commercial Real Estate Investing 101. So those were my three books. I got a fourth one coming out. I'm just working on the title right now. But I'm always in groups with different investors, and we talk, and I've had more people come up to me and say, I'm rereading emerging real estate markets for this next run. And I'm like, good idea.
Good, prepare. Well, David, I want to shift a little bit, and I want to shift towards the education course that you've created. And I think it's obvious that you're a teacher and you're very good at it. Now, what really prompted you to start educating others in real estate?
So I got so many requests when that book came out, to teach. And do you know Ron LeGrand?
What was his name?
Ron LeGrand. He's an old-time house flipper, and he's still out there.
Really?
He's still
wow, I haven't.
Yeah, so I first started with credit cards buying my multifamilies because I didn't have any money. And then I went to hard money, which at that time you could get they would finance you if you were buying it at 65 cents on the dollar, 100%. Wow. So I did that. Mm-hmm. And then as I started getting cash flow coming in, I realized I wanted to buy more multifamilies so I could use that cash flow as down payments for single families, flip them and get more from multifamilies. So I had to learn how to do that. So I went down to a big Ron LeGrand convention, and he taught me how to do that. And I'm not sure why I mentioned his name. Do you remember why?
No, the question was what contributed to you wanting to start educating others in real estate?
So I got a call from a girl by the name of Robin Thompson, who, like, when you start learning this business, you want to learn everything you can. So I became a seminar junkie, and you start seeing the same people at the different seminars. And we went to Ron LeGrand, Lou Brown. All these were single family flippers. Everybody thought I was still crazy for doing multifamily. But we went so you'd start seeing the same people again. And then, like, they were the next generation of teachers: Robin Thompson, Jeff Collar, Tim Mai, a lot of different people that through that generation. And I got a call from Robin one time, like 10 years later. And I hadn't seen her in a long time because I just focused on my multifamilies. I stopped going to those things because I got what I needed. And she said, how you doing? And I said, good. And she says, what's new? And I said, I'm up to, like, at that time, I think it was 1,200 units. I go, like, 1,200 unit portfolio. She goes, what? That's crazy. She says, I'm teaching now. I'm doing boot camp. She goes, how would you like to teach multifamily on the last day of my boot camp? Do like a 2-hour presentation. I said, sure. I'm from Boston. She's from Connecticut. I said, sure, I'll ride down and then we can have dinner together. And I did. And I got 3 invitations from 3 presidents of real estate investing associations. They're like, hey, how'd you like to come to our group? And I thought, that'd be interesting. And that's when I started thinking, hey, I could make this into a business, just like Ron did, just like Robin did. So that's how the education business came about.
Hey guys, if you're enjoying the content of our podcast, but you have additional real estate investing questions, I'm happy to answer those questions for free. Head over to redseacapitalgroup.com and book an appointment with me. Not only am I the host of the show, but I am actively buying and already own properties across the U.S. So feel free to schedule a time that works best for you. Visit redseacapitalgroup.com to book your appointment today. So if someone's considering starting their own education course, would you be bearish or bullish to that idea, if that makes sense?
I would be bullish because, there's an opportunity. So there's an opportunity in education where you create the content once and it pays you over and over again. Now, let me just qualify that too. I mean, get some experience. There's some, I didn't start teaching until 8 years into me doing business. There's people out there that understand that the education business is a very lucrative business, and they'll do 1 or 2 deals and then they're out there teaching. And you do that, and eventually you get people in trouble because you don't really understand the investment game either. You haven't built that real estate gap, but yet you're teaching other people how to do it. And you basically, so you just got to, if you're a student, you've got to make sure you know who your mentor is, who your teacher is, and what their qualifications are. And if you're somebody looking to get into the education space, I mean, it's a great space to get into. I mean, as you know now, there are so many people that are funding their deals through education. They're not necessarily selling education, but they're giving free content, free education to show people what they're worth, and that they're good quality people to be investing in. One of the smartest things I've seen, happening. It's the biggest change. For 6 years, I didn't step aside. It was just a time in the cycle. We had built this big portfolio. We're still doing one-off deals, but I had kids. And I thought, I don't want to travel so much. I stopped teaching my events. I have other people teach for me, except for Ultimate Partnering, which I'll always be the host there. Mm-hmm. So I didn't need to raise money because I had so many investors inside of my pool. So we're doing one-off deals here, one-off deals there, operating the portfolio, and all of a sudden, it's okay. Now it's go time. My kids are 6. It's go time. Start to get reset for this next run. And all of a sudden I start, I get back into it. I start reading the new books that are out there, which were a lot of them in 6 years. It was amazing. And then I start realizing that, holy crap, people, instead of going to these meetups to raise money, they're actually raising money through social media. And they're doing a really good job of it. People are getting to know people, not even meeting them face to face. But I had people, I started asking people about it, it was something new that I didn't know. So I started asking people, my old friends, hey, because I see you on social media, how's that working? And they're like, Dave, it's unbelievable. People listen to my podcast, they see me here and they see me there, and they feel like they already know me, which they kind of do because, eventually if you listen to so much stuff, you get to know somebody. And they said, they give me a call and they say, I want to be in your deal. I'm writing you a check for $50,000 or $100,000. And they say, I never even met the guy.
Mm-hmm. Wow.
So I'm like, damn, that's good. So that was a one big thing that changed. The foundations of how to invest in commercial properties are still the same. You need to know what cycle you're in for what strategy it is. You need to invest conservatively. But raising money, if you've got any type of personality, got a whole lot easier.
That makes complete sense. Wow. And David, I feel compelled to ask one more question. It sounded like your dad really had an influence on you being, having 3 jobs he did, and it sounded like a business as well. So that background, how do you see that aided you in becoming who you are today?
The answer to that is difficult because my father, growing up, we were complete opposites. So therefore, it was a very difficult relationship. He did work 2 and 3 jobs to support us. His legacy he wanted to be was that he paid for his kids' education. So he just busted his ass and he worked and worked and worked. But we just had 2 different personalities. It wasn't until I moved out of the house that we became friends.
Oh, really?
And then we became best friends, which was awesome. But we were living on the same roof. We couldn't stand each other. But his work ethic. He was an engineer, by the way. His primary job. So again, complete opposites. I'm an entrepreneur. He was right. He was left brain. I was right brain. And so his impact on me was the fact that family values, work ethic. I remember when I told him, I wasn't going to be at one time my title was apartment king. That's what I came out as when my first course. But I didn't want to be apartment king. I wanted to be laundromat king because I thought that's where I was going to make all my money. I thought laundromats were a good idea. I started going to all the seminars on laundromats. I asked him if he would give me the down payment for my first laundromat, which he agreed to. And then it was the night before the closing when we were at dinner, and he was really quiet. And I could sense something was going on. I was like, Dad, what's going on? And before I could even get it out, he said, I just can't do it. And I knew exactly what he was talking about. I said, you're not going to put up the money tomorrow? He said, I can't do it, Dave. I'm not sleeping at night. He says, I trust you, but I'm just not sleeping at night. I can't live like this. And I was like, damn. And so I couldn't buy that laundromat. I actually lost like $3,000, and $3,000 to me back then was like huge. And what that did to me is I swore I would never put myself in that same situation again, where somebody had control over my destiny. I did. So then I thought, what else can I do? And that's when I saw the Harry Helmsley interview in the real estate and all that, and I was like, it's real estate. I can buy with no money down. I'm going for it.
Wow. Thanks for sharing that. And that's a really inspirational story. And I can relate to that in the sense of I me being an entrepreneur, I can't see my own destiny being in a job. It's just, I don't have control of that. And so I think a successful entrepreneur, that is part of that. It might not always be the case, or might not always need to be, but I think that's pretty important. Now, David, we'll go ahead and transition to the final three questions. And the first being, if you can recommend a book to our listeners, what would that be?
That would be Joe Dispenza's Becoming Superhuman.
Okay. Becoming Superhuman, what is that about?
That is about your mind and mindset and energy in the quantum field. And if you read through that book, that will help you to understand how to get whatever you want. And, I've been teaching now for over 21 years. And we've been teaching, the program evolves, but the fundamentals are the same, okay? And there have been so many people that have taken that program and have gone out and become decamillionaires, through the time that we've taught. And there are some people that have just completely failed. So what's the difference? It's the same program, it's a proven program. So why are some people failing and some people are so incredibly successful? It's mindset. It's what you believe inside your own head. It's when you realize, and this was the same for me. I was in that rock and roll band for so long, and my life didn't change until I watched or I got the cassette tapes, and they're actually given to me by Earl Nightingale called "Lead the Field," and I listened to it, and I actually started doing the things that he said, and it started changing my life. And I was like, "Holy crap!" Then I read "The Strangest Secret." By the way, this and the next book, Anthony Robbins' "Awaken the Giant Within." I got that next. And man, my life changed so fast when I started applying all those principles. All three of those are free on YouTube right now. You can listen to them.
Wow.
But those were the things. And when I realized, it's like, wow, if I changed my mind, I changed my life. And ever since then. And, I started teaching, and 3 years into teaching, we started doing surveys on people and their success, and people weren't as successful as I thought they should be. I was like, why can't they go out and do it too? And I didn't realize that a lot of people had to go through the same transition that I did. You know what I mean? A mindset change, the fear and the mindset change. So I started teaching the mindset change and what you need to do. And I used to teach, go and do a 100 plus unit deal. They're so easy to do, and you make so much more money. But if your mindset isn't there, your subconscious will sabotage you and won't let you do it. So then I changed it to, it doesn't matter what size deal you do a deal that you're comfortable doing, because I know after you get your first deal done, you just take off. Like you blossom like a flower, you take off like a rocket. And when I started changing that and teaching mindset, everything changed. Our success rate got extremely, extremely high. But for those that follow the mindset principles, do you know what I mean?
I do.
So that's why I love Dr. Joe's stuff. He's Dr. Joe, right? So you hear about this mindset stuff and energy and the law of universe, and some people is like, oh, that's just foo-foo, It really isn't. If you get it. And all the successful people I know, I run a mastermind, right? So the first 2 days I call them doers, people that haven't done their first deal yet. And the second 2 days, I call them rainmakers and magnets, people that have done 3 units to plus 1,000, the magnets. And so on the first 2 days, I teach a mindset. Right? And it's all new to everybody. They're like, oh, yeah, wow, that's cool, yeah. The second 2 days, I start to teach mindset, and everybody's sharing. You know what I mean? Because they're all into it. They're all doing it. And that's how they're becoming successful. So that's the difference. So that's why, so Dr. Joe, there's no foo-foo in Dr. Joe. It's all, he's a scientist. And he can show you on the brain waves and how things are changing. And it's just incredible. So I follow that book, and I do the things that he says to do, and it's good.
That's good. Well, David, for the second question, if people want to learn more about you, where's the best place for them to do that at?
2 places. You can go to rementor.com, as in real estate mentor. That's our host site. And then you can certainly talk to anybody in the office. You can get the phone number there. And then if you're interested in being a passive investor, if you want to be passive for now, just go to passivefornow.com. And you can sign up and you can see the deals that we're doing. By signing up doesn't mean you're making a commitment, just saying that I want to see the deals that you're doing and how you do business.
That's fair. And the last question is, if you can share one final thing with our listeners that they can take away from today's show, what would that be?
I'm going to go back to mindset, because if you change your mind, you change your world. And it's not just your real estate investing world, it is your total world. You become a happier person, which we all strive for happiness, and you accomplish so much more. So mindset and action. I mean, you can read this stuff and you can listen to it, but if you don't take action, nothing's going to happen. Just like, the real estate space, you can listen to all the how-tos about how to invest in properties, but if you don't go out there and actually take some action, nothing's going to happen. So mindset and action.
It all starts in between your ears. That's it.
Totally.
Well, David, I thoroughly enjoyed this conversation. I think I have never taken as many notes in an interview as I did today. So thank you so much for being here. I know you really, thank you so much. Well, to the listeners, thank you for tuning in. We'll catch you next time. Bye.
It's time to grab your victory. Find us on the web at redseacapitalgroup.com and follow us on Instagram and Facebook at Red Sea Capital Group.